$3 trillion bucket of money. That's the figure it hit in 2020. As we know, it continues to grow. Leading super funds like Hostplus are the largest investors in Aussie venture capital, both via VC funds and direct investments into startups. Funds with a skew to younger members, often with multi-decade investment horizons, are particularly well suited to invest in private capital in innovative businesses as part of a diversified strategy. It's certainly a debate that has been going on quite strongly amongst the people I talk to. This panel is going to discuss the participation of superannuation funds in the innovation ecosystem. We have the brilliant Jackie Vullinghs from Airtree as our moderator. Welcome. She's just got here from the airport, so she's a FIFO worker today, ladies and gentlemen. Please put your hands together and welcome Jackie. And on our panel, we have Dr. Sam Sicillia, who is the inaugural Chief Investment Officer at Hostplus, all the way back to 2008. That's pretty good. Welcome, Sam. Paul Bassat from Square Peg Capital and Nathan Walsh from Athena Home Loans. I'm going to get off the stage and let these guys have a fascinating conversation. Over to you, Jax. Thanks.
Great. Well, just to set the scene, I think Aussie VC is really only in its kind of current form less than 10 years old. And many of those funds started out with just small funds funded by high net worth individuals. But over the last few years, we've really seen the kind of super funds come into the market, start backing VC funds. And at the same time, we've seen this kind of resurgence of Australian tech and these amazing billion-dollar companies that are coming through every single year. And it feels like they're at this kind of amazing turning point in the ecosystem where there's more super money coming through, there's more success, great returns for VCs, and I think it's a pretty exciting time. And at Airtree, we have 5 super funds backing us, and it makes me pretty proud because we know that now, if I do my job well, ordinary Australians get richer, and they're going to retire with more money, and it's very fulfilling. So it's a really great landscape, and I'm excited for this conversation. So, I mean, Sam, I'd really like to start with you and kind of understand how you think about investing in VC and how you think about what % of your portfolio to allocate and those kind of things.
Sure. Well, thanks for the question. It's my pleasure to be here today. So the way we think about VC, let me maybe step back a bit to the first time round back in the late 1990s and 2000. That story didn't end well, and a lot of people were scarred by it. But look what happened. The internet took off and technology took off, and so this time round we have what we have today. And even if it doesn't work out this time round, imagine what it sparks off for the future. So that's probably just some underlying tones as to what drives us. The way we think about investing in anything, including private equity, of which venture capital is a subset, is we think about, well, first of all, our fiduciary responsibilities is to make sure that we believe that there is an opportunity to make money for our members. In our case, to make money for Hostplus members. That cannot be negotiated away. So it's got to be the primary driver. But you can't divorce that from the secondary benefits. If you invest in venture capital, then you're providing funding to companies who have a shot at staying here rather than being forced offshore for capital. That means we're funding the economy of the future. That means jobs or company creation and job creation stays here. And if other industries fall by the wayside because of advancements in technology, or the importance of mining or agriculture becomes less to this country, then we better have something else for the economy to rotate towards. It can't be at the expense of returns, but it certainly goes with it. And then, Jackie, just finally, in terms of allocation, we think about private equity. At the moment, Hostplus's allocation to private equity is about 10% of the fund. So we're a $66 billion fund today. We'll be $70 billion by the end of this financial year. I only profess those numbers because 70 is a nice round number, and 10% of 70 I've got a chance of calculating in my head. So 10% of $77 billion in private equity. We currently have 6.8 committed, so that's fine. And we think of venture capital as about a quarter of our private equity allocation. And so it's roughly about $1.7 billion allocated to venture capital. We currently have $2.2 billion committed to venture capital all up.
And is that mostly local funds here, or is that a combination of local and overseas?
Okay, so this is a FinTech conference, but for venture capital as a class, it's about 60% local and 40% offshore. But FinTech is the other way around for some reason. It's 60% offshore, 2/3 offshore actually, and about 1/3 onshore.
Great. And Paul, you've taken funding from VC, from Hostplus, and how did you think about kind of whether to take super fund money, how much super fund money to take? I know, these super funds have huge amounts of capital to deploy, and so I imagine it's always a challenge having those conversations.
Yeah, look, I think, for us, we started our journey, 2012, and as you identified, Jax, I mean, basically the sort of the VC industry in Australia had disappeared. There'd been an earlier iteration of VC funds, a bunch of whom I'd known from my Seek days, and for whatever reason, as Sam said, they hadn't delivered great results, and they kind of eventually sort of, petered out, unfortunately. And sort of when we came along in 2012, it just so happened there were some other funds emerging in Airtree, Blackbird, Brandon on the life science side, and one or two others. And so kind of it was the beginning of a new wave of VC funds. And we did what in our first 3 years or so, what a lot of other local VC funds have done, which is sort of knock on the door of family offices, high net worth individuals, and we had some great support from those. We actually didn't do it through a formal fund. We did it through a series of SPVs, and that kind of suited family office style investors. It gave them a bit more flexibility and was something that they that optionality they put a lot of value on. But it was really clear to us probably from about 2014, 2015 that the family offices wouldn't scale in terms of, the size, because they were obviously only, again, allocating a relatively small portion of their balance sheets to venture capital, and their balance sheets are obviously much smaller than the institutional balance sheets. And so it was clear that it wouldn't scale. And if we wanted to really build something that was sustainable and could grow over time, it was really important for us to be able to raise, and for others to be able to raise money from institutions, in this country, largely super funds. And so we kind of knocked on a bunch of doors and spoke to Sam, relatively early in that process, and frankly spoke to a lot of other people at the time. And I've said this publicly, and this is not from a square peg perspective. It's from an industry perspective. I'll keep saying it until people get bored. But Sam and the team at Hostplus are absolutely the unsung heroes of the technology industry in Australia. And we know capital is incredibly important to, and having a strong venture capital industry is incredibly important to having a strong technology ecosystem. I can't think of a technology ecosystem anywhere in the world that's a really strong ecosystem where you don't have a number of really, really good local venture capital funds that are on their 3rd, 4th, 5th, 6th, 7th, 8th vintage of funds. And obviously that capital has to come from somewhere. And in Australia, the big source of capital is super funds. And as Sam said, most people you knocked on their door, like they'd just sort of scowl at you and say, you lost us money last time. Now, they weren't referring specifically to us, they were referring to the earlier generation of VC funds, but they were scarred by that experience. And so, the decision of Sam and the team at Hostplus to back us and back others has completely changed the curve, I think, of technology investing in Australia. And now kind of the next stage of it is, and Sam no doubt will talk about, is doing a lot of co-investing as well. And so that's a really, really exciting evolution.
Yeah, and I wanted to thank actually both of you here, Sam and Paul, for being such vocal proponents of the Australian tech industry in the media. I think we need every voice we can, and I think you've both been very strong supporters, so thank you. Nathan, you are one of the founders building one of these incredible technology businesses that aren't just based on kind of future hopes of revenue, but very solid revenue today. I mean, you've written now over $2 billion in home loans, which is a pretty astonishing feat in just over 2 years, so congratulations. You've taken investment from all of us. And so I'd love to kind of hear from you your perspective on, I guess, super funds investing in VCs, but then also taking money from super funds directly yourself.
Yeah, thanks, Jackie. I'm certainly privileged to have investment from both VCs that have super as one of the really important investors sitting behind them, but then also from Hostplus and 2 other industry funds directly as well. Should just say we're actually $2.5 billion of settled loans as of last week, so we're quite pleased with how that's motoring along. I think what's important is partly the scale of super, but I think it's also a story around the duration of benefits coming through. When you start to think about the time horizons, we're inherently an industry where one of the big sources of advantage is not being subject to that sort of quarterly, tyranny of earnings. And coming from, legacy bank scenarios where you've got incredibly talented people working hard with good intent, lots of resources, but often it can be really hard to really innovate in a major disruptive way to do the right thing by consumers over the long term. And so for us, clearly, access to funding is critical, and so clearly the support being provided, but it's also, if we were optimising a strategy with an assumption of a much shorter time horizon for what, if you had investors who are looking for a really short term, build something and flip it fast, as opposed to let's really go in and build foundations to do things very differently in a category, the boundaries of the possible are very different because we are supported with an ecosystem which has a very long-term, how do we go and play to win with investors with that kind of membership. So I think it's absolutely about access to capital, but I think actually the kind of investor register you have can lead to very different strategies that are possible for an innovator as well. And so that's what I think is particularly powerful for us.
Thank you. And Sam, it might be worth kind of as a case study talking about Athena in the context of how you think about co-investing with the super funds that you invest in.
Sure. So the reason we co-invest, or the primary reason that we co-invest, is the following. Just a little bit of maths, right? If we're a $70 billion fund and we have a 10% allocation to private equity, then a $1 million investment is 1/700th of 1%. And I can never get the board time with my board to discuss that small parcel when they want to allocate hundreds of millions of dollars to airports and power stations and toll roads, right? And so the way we do it is we are allocators of capital, right? One of my directors has a very fond statement that says, don't buy a dog and bark yourself, right? Give money to experts and then let them be experts. Our expertise is not assessing investee companies or founders or even venture capital sectors. Our expertise is allocating money to asset classes. We do that bulk allocation to venture capital funds like Square Peg. They in turn use their expertise to assess individual investee companies, or rather founders, like Nathan and Athena, and then make that investment. But then every now and again, Athena does a capital raise that's too chunky for Paul's fund. And so there's an opportunity for us to allocate a capital of money directly, if you like. We call that co-investing, right? But we won't co-invest in something that the venture capital manager hasn't already selected as an investment in the fund, right? And so we think about co-investing as taking a bigger bet on something that someone has already done all the hard work for. And so far our co-investment program, which is pretty close to $400 or $500 million now in size, has paid off in spades, and Athena is one of those.
It's a really kind of wonderful situation where you've got kind of long-term investors like you being able to invest tens of millions now for the potential to invest hundreds of millions one day in the future, and startups able to get long-term investors who can ride them not just through the private markets, but to the public markets in the future as well. To kind of change gears a little bit, I'd love to talk a bit about ESG. we've seen kind of big capital allocators in the US, like BlackRock, taking a stand now on ESG, and I know it's important to the superannuation industry here too. So I'd love to understand a bit about how you're thinking, Sam, about ESG within the VC funds you invest in and the startups they invest in.
Sure. So ESG's environmental, social and governance factors that are important. We know that they're important in determining outcomes of companies. Put simply, the way companies behave in the marketplace influences their investors, influences their customers, etc. And so those characteristics are important. The overarching label we use is responsible investing, right? And so as responsible investors, we certainly don't want to invest in anything that's engaged in activities that are irresponsible. In other words, sooner or later, they're doomed, right? But having said that, we would rather be owners of even those businesses and then have an opportunity to engage with them to get them to be more responsible than simply shying away from it and not investing in it and basically passing the hot potato on to somebody else to deal with, right? Because that somebody else may not be the kind of investor that will do something about it, okay? And the one that comes to mind, the easiest one that comes to mind is investing in coal. Even if you believe that coal, let me rephrase that. We know that climate change is a significant factor affecting the planet, and it's arguably the most critical thing on the horizon, and that sooner or later coal is doomed. But divesting your coal share, your shares in coal, just means you're transferring ownership from yourself to somebody else. You haven't affected the coal company at all, right? And so we would rather engage with them to nudge them in the appropriate direction.
Great, thank you. And Paul, I'd love to kind of get your perspective on that as well, kind of closer to the portfolio companies that you're investing in.
Yeah, we have these debates all the time, and I think we would call it a sort of an ethical lens rather than a sort of an ESG lens specifically. I think Sam's term of responsible investing, resonates a lot. And the sort of starting point for us, and I think one of the great things about being in venture capital as an asset class is, just about every company you invest in are kind of doing something really, really positive for the community. And so Athena's kind of like, sort of case in point with a shining light. It's not just the $2.5 billion of loans they've outlaid over the last couple of years, and obviously we hope and expect that number's going to grow really, really significantly in the next few years. But, it's kind of what they do to the market in terms of, it's not just the rates, it's not just the lack of fees, it's also the transparency and having an incredibly, fair offer to consumers where they know exactly what they're paying for. You have a certain interest rate, you have a guarantee that if you're a loyal customer, one of the things that banks do, and I understand the maths of this and I understand the logic of this, and I'm not sort of, passing judgment on this, but the reality is if you are a new customer of a bank, you are going to pay a lower interest rate than if you're an existing customer of a bank. They talk about their front book and their back book. One of the things we talk a lot about at Square Peg is you never make new friends at the expense of old friends. And it sort of feels like, the last folks that you should charge them more and sort of take advantage of their loyalty as people have been customers for years and years. And so this is a great example where just, one aspect of the Athena offering, which is every customer on a like-for-like basis pays exactly the same rate, whether they're a brand new customer or whether they've been a customer for 5 years. It would be hard for them to be a customer for 5 years, given the business has only been around for 2 years, but you get the point. And so the great thing about what we do is the companies we invest in, by and large, have a really, really positive impact on the community. But sometimes there are, complexities and there are issues about the go-to-market in a whole range of different areas where we have really vigorous debates about businesses and whether it sort of meets a sort of responsible investing or an ethical overlay. I remember one particular investment recently which we decided not to pursue. One of the people in the team said in the meeting, she said, I didn't join Square Peg to invest in this sort of a business. And one of the other guys said, I don't know what this conversation would look like with my mum. And I said, maybe like, what do you think? I don't care what your mum thinks. And he said, well, it's sort of hard to separate the two. And so it is a really important part of our DNA. And we are not an impact investor per se. And our obligation is to provide financial returns to our investors and back amazing founders. And you made the point, Jax, earlier about, ultimately we've got to remember whose money it is, and it's not Sam's money. We are custodians for Sam, who is a custodian for, well over 1 million people in Australia and so on, and same with Aussie Super and same with a lot of the other super funds in Australia. And so ultimately our responsibility is to provide returns, but there will be times where we decide not to invest in a company because it doesn't meet a particular filter that we determine. We'll be really honest about it. It's pretty subjective, and we have very active and aggressive debates within our team about whether a company meets that filter.
I really like that lens. We have a very similar thing of when your grandkids are sitting on your knee in decades to come, would you be proud to tell them that you invested in this company?
Exactly. It's a great way to think about it.
Yeah. And Nathan, you've been building a culture yourself, and I guess having come from kind of big corporate life to getting to start from scratch and build a company culture from the very beginning. Do you have any kind of advice for the founders out here on how to build a kind of ethical and inclusive environment?
Yeah, well, I think, for all the founders in the room, I think that is one of the really exciting things about being able to start with a clean sheet, new technology, really thinking through how models should work. That idea that you can start with a why and not just be a shiny face on an old predatory legacy model, right? We know that too much of finance is really making a lot of money from people who take their eye off the ball. They end up with too much money in a revolver credit card. They end up paying a penalty fee. They end up, paying that loyalty tax on a home loan and not realising they're overpaying. So setting up a model which is really a business that will deliver great returns to investors and at the same time for for customers, for community, those other dimensions. And so that's something that certainly, Michael and I and the broader team spent a lot of time talking about, right from the beginning of Athena. And I think what's really exciting in finance is there's lots of those sort of opportunities to build brilliant business models, but things that actually do things very, very differently. A big thing for us, though, is not just to start with that general intent of don't be evil, but actually how do you institutionalise, embed that back in? And some of that is things like culture. But we, for example, going through the B Corp process at the moment. So really, that's getting you to think through all of the various aspects of the business model. And a number of folks in the FinTech community are well ahead of us on that roadmap and actually gone through, and people like Huddle and others have been very generous with their feedback and thoughts about how to play. But really just that idea to say, well, how do we make sure we are really thinking about all of the aspects of the business system so that we are setting ourselves up to be sustainable? And what's fascinating is by going and thinking that through, in many cases that just translates into a better, clearer, more targeted business that is actually ultimately going to be better for shareholders as well as delivering a purpose that we can be really excited about.
Great, thank you. And I know we're coming up to time, so I just want to ask one final question, maybe of each of you, just because it's a pretty exciting one. I mean, what do you think the future holds in terms of, there's going to be more super capital, hopefully great performance from tech companies, which leads to great returns for VCs and more money piling in. We've seen a huge change in the Australian tech ecosystem just in the last 10 years. What do you see for the next 10 years? I'll start with you, Paul.
Yeah, look, you look incredibly excited. I mean, I think, I've been doing this for 20, in terms as a founder and as an investor for 20, whatever it is, 25 years nearly. And I was 12 when I started, I should add. And the rate of progress, it's a long time, it's a generation, but the rate of progress, particularly in the last 7 or 8 years, 6 or 7 years, has been phenomenal. So, I think we've got a long way to go on the journey. There's lots of areas where I think we could do better. But, I think, that's a sort of a glass half empty view, which is, we're only part way down the highway. But the glass half full view, which is, I think, a much more accurate view, is it's less about where we are, and we're in a pretty good place, but it's less about where we are, and it's more about the speed at which we're travelling, and it's really, really exciting. And, companies like Athena and if we're talking FinTech, there's some amazing FinTech companies in Australia. Walsh is obviously another company we love, Melbourne-based FinTech. We are seeing more and more great technology companies emerge out of Australia. And, 5 years ago, it was a handful of names, and now it's dozens and dozens of names. So it's super exciting.
Sam?
The reason why I'm excited about the immediate future from a funding perspective is that my peer super funds have put money into this sector, but they need to do more, and we need to do more. And so as the evidence starts to mount and as the ecosystem starts to build, it'll naturally draw money from the big source of capital in this country, as Paul put it, which is superannuation. And so we'll do our bit to contribute to that, and we'll also do our bit to hold the hands of some of our peer super funds who haven't taken that step yet, but should, right? And so said another way, there are billions of dollars that are going to be directed towards the Australian venture capital ecosystem. And so build better companies, and the money is here already.
Here.
Nathan, how'd you like that message?
It's pretty hard to top that one. I think what's exciting is clearly, constraints that may have been a challenge in decades past. Clearly things are in a different position, but I think also just that ability to build great innovative companies in Australia. We're clearly in a better place than ever, and that's both for products, companies like ourselves focusing on a domestic opportunity, but equally clear in a remote world, the opportunities to go and build the global scale companies where the Australian footprint ends up being a really, really important part of where innovation comes from. I'm particularly excited, and just the opportunity over the last hour or so just to speak to so many of the folks here and hear about all these exciting, at all various stages. I couldn't be more optimistic that Sam is going to find a bunch of world-class investment opportunities to deploy that capital.
Oh, thank you everybody for your time.
Jack,